Today, the US dollar reached its highest level in almost 5 months, and not least due to the rapidly weakening yen. After all, the Bank of Japan remains the regulator that pursues the most powerful accommodative monetary policy in the world. Perhaps when on March 19, Japan's regulator moved the basic settings from the minus 0.1% zone to plus, they expected a slightly different development of events. First of all, the rapid transition of the Federal Reserve and the ECB to monetary easing. The euro area somehow fits into these forecasts. But in the United States, as fresh economic reports arrive, the timing of the first rate cut may well be published back to the second half of the year. That's why the Bank of Japan's policymakers, although they declare their vigilant monitoring of the currency market and their readiness to intervene, are still wary of coming into gridlock with such measures. After all, everyone understands that Tokyo's physical intervention will have a short-lived effect. Therefore, it's much more important for Japan's monetary authorities to buy time for the yen in the hope that the dollar's strength will weaken soon. Moreover, fears of intervention from the Bank of Japan still somehow slow down the growth of the dollar-yen pair. However, this did not prevent the US dollar from testing today its highest levels since November last year. The US dollar index, which determines the strength of the greenback relative to 6 major peers, is trading in the intraday corridor of 104.80 to 105.10. The dollar's advance came in a light of a stronger than expected economic data for the United States, and the recent reports enabled the markets to revise forecast for the Fed's rate cuts in June and pushed up the rate of the US currency. Nevertheless, later the greenback retreated as the euro and the pound sterling got a second wind. On the back of the firm US dollar and upbeat economic reports, US stocks have had to scale back their growth ambitions. While the artificial intelligence boom is adding energy to stocks, the overall market indicator S&P 500 closed its first April session in the red. And today it remains in the bearish zone, keeping on with its decline within the intraday corridor between 5,229 points and 5,264. As yesterday's reports showed, the US production expanded for the first time in a year and a half. The S&P manufacturing PMI jumped from 47.8 in February to 50.3 in March. The index of new manufacturing orders also exceeded forecast and February readings. The flash estimate was 49.8 and the February index was 49.2 respectively. The index surged to 51.4 in March. However, the recovery in production is also a stimulus for inflation. After all, the sector will have more commodities and fuel. So, these categories continue to rise in value. For example, yesterday's report showed a sharp increase in the price component in the manufacturing sector. With the forecast of 53.3 points, its indicator rose to 55.8 and fueled fears that the decline in inflation to 2% may be delayed. Meanwhile, market participants are trying to puzzle out when and by how much the Federal Reserve will cut its interest rates. Experts from one of the world's leading banks, Goldman Sachs, predicted that the official funds rate would remain at the current level until June. At the same time, they suppose 3 rate cuts of a quarter point each by the end of the year. For the euro area, the 2024 forecast from Goldman Sachs looks softer. 5 rate cuts by a quarter of a point, but the first round of monetary easing will be also in June. A preliminary estimate of inflation in the Eurozone will be published tomorrow. Perhaps on a Wednesday, we will receive a final answer to the question of who will be first on the path to easing rates. The Federal Reserve, or the European Central Bank. Today, the single currency received support from a better-than-expected data on the Eurozone manufacturing sector. As reports showed, the PMI for March was revised. As a result, it rose from a preliminary estimate of 45.7 to 46.1. Of course, these statistics can only be defined as partly positive. Indeed, the manufacturing PMI is still below the threshold level of 50 points, which separates growth and contraction. Nevertheless, in anticipation of the non-farm payrolls, the euro-dollar pair is not trading flat. After consolidating in the range of 1.0728 and 1.0740, the euro went on the offensive by the beginning of the American session and tested the high of 1.0758. The euro may have found support in the stronger pound sterling, which ranks third in the dollar basket and which rose on optimistic manufacturing data in the UK. But most likely the main reason for the euro's growth lies in the pullback of the greenback in anticipation of new statistics from the United States. Therefore, the growth impulse that we are now seeing in the euro may also quickly change to a downward move in the opposite direction. And after the report on vacancies in the United States, we saw that the euro-dollar pair stalled its growth. This week, investors will focus their attention on the US employment data for March, which will be published on a Friday, and the non-farm payrolls could suggest that when the Fed might start cutting interest rates. And today, the data on the US vacancies came out. The report showed that the number of vacancies increased to 8.656 million in February and thereby confirmed the stability of the American labor market. Oil prices anticipated the opening of European markets. As soon as the European trading floors reopened after the long weekend, crude oil began a rapid rally. The Brent price rose to almost 5 months highs, $89 per barrel. Unfortunately, the main driver of its growth is escalating tensions in the Middle East, including from Iran. If the situation worsens, it will immediately lead to disruptions in the supply of petroleum products from the main oil-producing region of the world. If Tehran and Tel Aviv try to reach some kind of settlement, then we should expect an inevitable pullback. In the meantime, oil prices are still trading higher amid expectations that economic growth in the United States and China will stimulate demand. Thereby, its equivalents are trading today in the intraday corridor of $87.70 to $89.10 per barrel. If the uptrend continues, Brent Crude might approach the resistance level of 90. So, you have watched the market review by InstaForex analyst for Tuesday, April 2. Subscribe to the InstaForex TV channel and we keep you updated on all market developments. Feel free to ask any questions and leave your comments. I'll see you online tomorrow.